Many beginner investors are keen to get started investing because of the easy money that can be made, and rightly so. Those of you who have watched our videos before will know that it is far better to put your money to work than to work hard yourself.
Without exception, the only way to make serious money is to invest. Look at any rich list and you'll see a bunch of people who made their wealth from investing, most commonly from stocks or property.
Unfortunately, to start investing without educating yourself is a recipe for disaster. You will lose money. It is imperative that you not only learn how to invest, but you also learn from your mistakes. Better yet, learn from other people's mistakes so you don't make them yourself.
Warren Buffett has 2 rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Investing mistakes will cost you money, but why is it so important not to lose money? Some of you might be thinking that it's okay to lose money because eventually stock markets will recover and you'll get your money back and more.
Let's demonstrate this mathematically. Say that you invest £10,000 and you lose 50%. How much does it need to grow by to get back to square one? 50% maybe? Wrong. To grow your remaining £5,000 back to £10,000 would require a 100% investment return just to get back to where you started. The more you lose, the bigger investment return that is required just to recover.
Some people are even tempted to buy stocks that have crashed by, say, 90% because they are convinced that it was once worth so much more. Imagine you owned one of these stocks and you are unfortunate enough to see it crash by 90% and have held whilst you lost all your money. To get your money back, it would need to grow by 900%. Nothing short of a miracle.
Now that we've demonstrated why it's so critical not to make mistakes, in this video we're going to look at the 10 biggest mistakes that beginners make in the stock market. Let's check it out.
Welcome to Unshackled.com, the investing channel and website that sets you and your finances free. This is Andy, I'm Ben, and if you like what we have to say, hit the like button and click subscribe.
Don't forget to check out the Unshackled.com office page where we have hundreds of pounds of cash bonuses that you can snap up when you sign up to any of the investment and peer-to-peer lending platforms listed. We'll put the link to this office page in the description below, so be sure to check that out. Let's get into the video.
Mistake number 1, not diversifying. Diversification is absolutely essential to protect and grow your wealth. Beginner investors often fail to diversify properly due to lack of money, lack of knowledge, or overconfidence in their ability.
These days, lack of money is no excuse, as ready-made diversification is easily achievable through the purchase of a fund or ETF. Unfortunately, many beginners dislike funds and are drawn into the excitement of picking individual stocks, but in doing so they almost never achieve the diversification that is so vitally important.
Lack of knowledge often leads to a beginner investor believing that they are sufficiently diversified, but the reality is usually not the case. For example, a UK investor may rather foolishly only be invested in UK stocks. If the UK suffers a downturn, that investor will soon realise that they are not diversified properly. True diversification is across different geographies, asset classes, sectors and stocks. Diversification doesn't just protect against losses though, it actually boosts the chances of you achieving the investment returns that you had expected.
I've personally made this mistake myself. For years I was overly exposed to the UK and I failed to get enough exposure to the essential US market, and as a result I missed out on some tremendous growth. Whatever the reason, lack of diversification is going to hurt you.
Mistake number 2, copying other people. Everyone's situation is different, which is why a regulated financial advisor has to first assess your unique situation before giving advice. This fact is often overlooked though with beginners who just want to copy someone.
We are often asked which investment platform we use or what investments we hold. There's nothing wrong with these questions per se, but these questions terrify us because it is clear that most of those who are asking are going to blindly follow whatever we say. Our situation is different to yours and yours is different to the next guy. It is much better to understand the reasons of why we do something than just to blindly follow what we do.
For example, if you only have a few £1,000s to your name, it's not useful knowing which investment platform we use because we are not in the same financial position. Or if you're approaching old age retirement, it's potentially a dangerous thing to follow letter for letter our investment strategy because we are more likely to take on more risk than you. Long story short, don't blindly follow other people, but understand why they do something.
Mistake number 3, CFD trading. We covered this in a recent video about avoiding CFD trading, which is certainly worth checking out, so we'll link to that in the description below. Essentially, due to high fees and leverage, 82% of CFD clients lose money, so beginners should pretty much always avoid this type of investing. Unfortunately, these CFD brokers have large marketing budgets and have some really enticing adverts which lure newbie investors to their peril.
Beginners often come across this type of broker first and think that it is investing in the traditional sense. It isn't. Beginners would be better to avoid this type of broker and focus instead on traditional investing platforms.
Mistake number 4, holding losers and selling winners. Many investors sell their best performing stocks to realise a gain, despite that share possibly having further to grow. But worse still, many people are unable to sell a loser, preferring to hold until total collapse of the share price. There is too much emotion in the investment and they make all the wrong choices.
Even if the loser slowly recovers, how long have you had to wait and what did you miss out on? Many investors incorrectly believe that what goes down must go up. This is a misconception and it's often not the case.
Mistake number 5, buying high and selling low. Everyone knows what they should do. Buy low, sell high. Yet everyone tends to do the opposite, and this is not a contradiction of the previous mistake.
When stocks crash, people become fearful and sell, and likewise, when the price skyrockets, they jump on the bandwagon too late. The best thing you can do is ride out any crashes and perhaps buy more if the prices are cheap.
Mistake number 6, trading too frequently. Novice investors incur substantial fees by trading too frequently. Normally they are trying to make short-term gains or are just bored and are therefore hurt by the high fees.
Consider this, you have the fees to buy and then the fees to sell, you have stamp duty and you have the bid offer spread. In case you don't know, you can't actually buy at the stated share price. There is something called a bid offer spread, which is the difference between the buy and the sell price. This bid offer spread and stamp duty on UK shares is unavoidable even on the free trading platforms. Our point? Trading too frequently can be costly.
Mistake number 7, overconfidence. Some people think they are better than everyone else, while some people think they can outperform the market despite putting no investment appraisal is beyond us. We're not saying you can't beat the market because you can, but many beginners think that they can pretty much just take a wild punt and outperform the professionals.
We regularly get asked about time in the market or whether a particular stock looks good. We love to talk about anything to do with investing, but the reason we do better than most is not because of our awesome skills, but because we avoid these mistakes.
Mistake number 8, not starting or starting too late. Investing works best when it has time to work its magic. The true power of compounding takes years. We've heard every single possible excuse known to man why people don't invest. All too often, they prioritise short-term gratification over their long-term future. Don't wait to invest. Invest and wait.
£10,000 invested for 35 years earning 8% will be worth £148,000. £10,000 invested for just 10 years earning 8% will be worth just £21,600. Don't wait to invest, invest and wait.
Many people don't start because they think their tiny sum isn't worth investing. They fail to realise that the best way to learn is when their pot is small. If they save a large amount first, then they will be too fearful to invest because they now have a lot of money to lose.
Mistake number 9, short-term horizon. The ability to sell shares at any time, what we refer to as liquidity, often leads people falsely to believe that they can invest for the short term. But in reality, prices are so volatile in the short term that it's way too risky. Some short-term traders may do well out of this, but you will almost certainly do better with a long-term investing strategy. Long-term being at least 5 years, but preferably 10 plus.
Mistake number 10, buying last year's winners. People have a tendency to review the historical record and assume that it will repeat. Sometimes it might, but it may not. When making an investment decision, you need to look at the future and not just the past. If it was as easy as looking at the past record, then we'd all be multi-millionaires.
Question of the day, which investing mistakes did you make or are still making? Let us know in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. If you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.